Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm very pleased to have with me once again Alasdair Macleod. Alasdair has a background as a stockbroker, banker, and economist. He is a senior fellow at the Gold Money Foundation and head of research at Gold Money. His weekly articles written for Gold Money are posted there at goldmoney.com. In fact, I've found Alasdair's articles written from a free market perspective to be highly logical, and the insights that he provides are very unique, I would say, quite unique, and you're not seeing them that those insights expressed that widely, and so it's always valuable to have somebody who brings new ideas and a fresh look of things. That's why I'm really happy to tell you that Alasdair is with me again. Thanks for joining me again, Alasdair.
That's my pleasure, Jay.
It's really good to talk to somebody thousands of miles away across the pond, and I really want to ask you about your valuing gold in a world awash with dollars, but to set the stage for that discussion, I'd like you to talk about something that you've really helped us with in the past, and that's the credit cycle. You know, it's not a business cycle, it's a credit cycle per se. It's everything is driven by money pumped into the system or taken out. Not much of it is usually taken out, a lot more going in constantly than coming out. But tell us, give us an update of where we are in the credit cycle. I believe we're nearing the end of it, and what does that portend for the future?
Yes, I think we are towards the end. The symptoms that suggest that to me is that not only have we got full employment, price inflation, for what it's worth, and it's always an inaccurate number, is above the Fed's target. The Fed does recognize that it's got to tighten. Otherwise, its 2% inflation target is going to get left behind. You've got full employment. They're also looking at President Trump and saying, hold on a minute, we've got this huge, great deficit as a result of lower taxes and higher government spending. This is going to be an injection into the economy. I think they're probably also looking at the effect of tariffs, which is going to put up prices. So in that sense, it is price inflationary. The Fed actually has quite a lot on its plate, and it's all happening at the very mature stage of the credit cycle. And I think it's going to hasten the end of this mature phase. Just to sort of recap very, very quickly, the credit cycle starts from the last crisis. We get over the last crisis, and we get over it because basically the Fed chucks money at the problem, stops everybody going bust, rescues the banks, tells the banks not to foreclose on anyone if they can possibly avoid it, and so on and so on. Public confidence is very, very low. The result is that most of the money that is printed and the bank credit that is expanded doesn't find its way initially into the economy. It finds its way into assets, so that you see government securities rising in price, yields falling. You see equities beginning to move better on the back of that comparative valuation with the US Treasuries. You then get property prices beginning to pick up. And all this because the yields for conventional assets are high relative to zero interest rates. That then continues to develop, and money begins to seep from, if you like, the financial side of the economy into the production side of the economy. And it's nowadays it's not just production; it's also consumers, because a lot of it is in the bank credit expansion goes into consumer finance. So you get to a point where prices do begin to rise. Now, unless the Fed in fact, the Fed can't actually do anything to stop it. All it can try and do, perhaps, is to try and get interest rates in step with what's going on in the economy. That's what the Fed is trying to do. So the rise that we're seeing in interest rates is clearly a signal to me that we are in that very mature phase of the credit cycle. And what happens after that, I'm afraid, is another credit crisis. It is as sure as night follows day. It is sure as you get a spring tide every 2 weeks. If you live on the sea, you know what that means. So it is a fact of life, and it's the one thing that central banks cannot prevent. They actually create the credit cycle. It's partly them, and it's partly the banks that they look after, that they regulate. The expansion of bank credit is something that happens and fuels the credit cycle from about sort of mid-stage onwards. We now have this credit cycle in a very mature situation. I think that you will see in the coming months, and it's a matter of months, you'll see that inflation will rise even further. I think you will find that the interest rate outlook, again, people will be talking about, well, the Fed's got to have yet another one next month when it wasn't expected before, that sort of thing. And I think that the timing for the credit cycle's end, which is the crisis, is likely to be sometime between the last quarter of this year and the end of the first half of 2019. That's what I've penciled in at the moment. Now, there's not a lot of time with that earlier date. But it's just that the way I see things developing, the way I see the sort of tariffs, the likelihood of tariffs coming in, that getting worse, the way in which government spending has rocketed up without the tax cover, which is an enormous stimulant, if you like, into the economy at the time, at the worst possible time. I think that it's going to just hurry things up quite a lot. Anyway, so that's that. Now, what happens after that? Of course, we embark on another cycle, but these things are always different from last time round. And one of the points, which actually is what gold is all about, is that we still have an enormous hangover of cash within the banking system. We're talking, by cash, I mean physical cash. Checking accounts and deposit accounts. That at the moment is around about $12.8 trillion. Wow. It's roughly something, I can't remember, I think I worked out the figure, something like 70% of GDP, whereas at the time of the last credit crisis, it was about 35% of GDP. So you can see that we're going to go into the next credit crisis with a huge amount of dollars washing round the system. What does the Fed do? How does it rescue the economy next time round? Well, the answer is quite simple. It chucks money at the problem. But there is already so much money in the system, so you're going to get more money on top of it. I mean, we can easily see that if I'm right about 2018, 2019, you could easily see that by the time we get to close on 2020, that we have more than the GDP in cash. I mean, it's completely bizarre, but that is where we're going.
Well, it's incredible if you get that much cash sitting around in the banking system, and the banks have started lending, as you pointed out. At a certain point in the credit cycle, it becomes advantageous for banks to sell their treasuries and start using the cash to start making loans. I guess that process is very much in place, and of course you have the multiplier effect, right, that can really accelerate the amount of money and the amount of demand for goods and services that are out there, right?
Yes, you can. There is another aspect of this which I think is very concerning, and that is that at the time when the banks should be lending money to business, actually what's happening is that Donald Trump is asking for yet more money from the banks. One way or the other. I mean, the banks may not directly buy bonds, but they will be financing people who will buy bonds. I suspect that will be cured in one way, and that is that foreign central banks will be persuaded to buy each other's government's debt. That I can see happening if yields start rising too much. I can't see where all the buyers are going to come from for this enormous uplift in government debt that I can see over the next sort of 6 months or so.
Maybe the government's going to tell us little people that we have to buy treasuries, or maybe they're going to take our 401ks and tell us we have to buy. Who knows? Governments who knows where it's going. But where do you see the breaking point then? I mean, you think the credit crisis is coming. We're up close to 3% on the 10-year treasuries here in the U.S. I mean, we have so much debt, as you point out, that the service charge, the cost of servicing that debt for the federal government is enormous. And of course, corporations have taken advantage of low-priced money to go out and buy their stock back, and they put debt on the balance sheets of corporations. I guess that's not the primary concern, but it's all sort of comes together. Alasdair, normally what happens when we have these credit collapses, as we had in 2008, 2009, you have the world's reserve currency, the senior currency, the dollar, gets stronger because it is, there's more debt in dollars than any other currency. So when the system starts to go into reverse, when defaults start to occur, then people have to sell whatever they're able to sell to buy dollars. It forces the dollar up in value. Do you see that happening again in the next cycle, in the next end of this year, early next year?
No, I don't. I mean, you are right that in the past this has been the case. This is something which many people have written about recently, something called the Triffin dilemma. Mm-hmm. Robert Triffin was an economist, a Belgian-American economist, who pointed out that the reserve currency, the issuer of the country that issues the reserve currency, has to run a trade deficit, which means a budget deficit, because the two things are interlinked, in order to create the currency required for it to operate as as the international currency, the yardstick for all the others and all the rest of it. Now, that is fine to a point. It's fine so long as the amount of currency that is actually produced for export is still demanded. But we now have a situation where, and I point this out in the article which you referred to, where the cumulative US dollar capital flows quite clearly show that the foreigners are up to their necks in dollars. They've got more dollars than they need. Now, if we go back to the crisis, when the crisis happens, what you do is not quite what you said. What you do is you get rid of the foreign stuff. Mm-hmm. If, let's say, you're a Malaysian corporation, the government, if nobody else and your shareholders are going to tell you, you protect your home business. You do mm-hmm. not protect the international stuff. So the first thing you do basically is you get rid of the foreign stuff. Now, in the past, what has happened is that multinationals have many, many currencies on their books. Mm-hmm. What they have done is they've got rid of everything else except the dollar, because that's mm-hmm. the one thing which they probably need to pay for their international loans, the interest, and all the rest of it. So, but now, what I can see is that there are so many dollars around that people have got so many. I mean, they've just got too much of the stuff, mm-hmm. and on a crisis, they're bound to get rid of the dollar. I mean, just looking at the figures that the U.S. Treasury mm-hmm. produces, the net foreign investment in U.S. dollars between 2009 and 2017 was just mm-hmm. under $9 trillion. Mm-hmm. Net U.S. investment abroad, which is the other way, has mm-hmm. actually contracted. So in other words, U.S. corporations have already reduced their exposure abroad, and mm-hmm. that's contracted by about $155 billion. Mm-hmm. You've got a balance of trade in goods and services, which over that period is $3.7 trillion, mm-hmm. which means that their net capital flows unaccounted for work out at about $5 trillion. Now, compare that with the previous credit cycle, 2003-2008, and it was only $462 billion. So we have got
more than
something
10 times,
more than 10 times, about 12 times, exactly that. Now, if you look at the notes, sort of digging down in the numbers which the Treasury produce, there's something which is supplemental to Table 1, is foreign investors' dollar liquidity, which exhibit 19T in U.S. portfolio holdings of foreign securities as of June 2017 is recorded as an extra $4.217 trillion. So what we can see is that the unaccounted bit, in other words, what is not actually invested in foreigners' hands, which we worked out should be a figure around about $5 trillion, we can see that 4.217 of that is actually cash.
Wow.
It's sitting there in the U.S. banks as cash, beneficial owners, non-U.S. corporations. So, what's going to happen on the next credit crisis? The answer is that you got a tsunami of 4.27 trillion of dollars, which are going to be sold.
Yeah.
I mean,
sure, because these companies have to take care of their own issues first. I mean, they're not concerned about helping the United States necessarily. And I'm wondering also, when you talk about Triffin's dilemma, if some of Trump's policies, the tariffs, his pressures on NATO, for example, and even the reversal of the Iranian deal that Obama struck, whether they might not actually also reduce the dollars held by foreigners. It seems to me that was what it. I mean, clearly Trump is trying to pay back the people that voted for him in Middle America, bring manufacturing jobs back, and so forth. Do you think that fits into the story of Triffin's dilemma as well? I mean, in terms of what you're talking about.
Yes, it does. It does, Jay. I mean, we're now sort of walking into the realm of geopolitics, I think.
Yeah, sure.
I mean, particularly with the Iranian situation. The Iranians export oil to China. China has set up an oil yuan futures contract, which will allow countries like Iran and various others to sell oil to China, bypass the dollar entirely, and then I believe what will happen is that they will be attracted by a matching contract where they can turn their yuan into gold and just stand for delivery. And the two exchanges where gold futures in yuan are priced are Hong Kong and Dubai. I would think that the Americans are going to lean on Dubai. Dubai probably won't be able to take part of this, but they can't lean on China. And incidentally, another part of this is that the European Union is refusing to go along with American sanctions
in Iran.
So actually, what's happening is that the Europeans are saying to their companies, "We'll protect you as much as we can," but as we saw today, Daimler-Benz, have had to take a decision: which is more important, our American business or our Iranian business? And the answer is their American business. So they're cutting their Iran link, which is actually pretty much what Donald Trump is trying to get going. But he won't be able to stop the Chinese buying their oil, paying in yuan. They can stop the dollars, and when it comes to banning anyone selling them gold or other precious metals, as it's described, they can't tell China where to get off on this one, or the Asian exchanges. So it looks to me as if this could backfire, and it could generate some demand for physical gold on the basis that it will be delivered against an oil yuan contract, which is turned into a yuan gold contract.
Yeah, I saw today it was limit up for the petro yuan. So the very day that the sanctions were placed on Iran again. Alasdair, with just a couple of minutes left here, I want you to talk just briefly, as succinctly as you can, about the paper gold markets and how what we're just talking about, the petro yuan, could be one aspect of breaking that. And what happens? To what extent do you think the paper markets have suppressed price discovery of the price of gold? I mean, what we want to try to understand is, how do you price gold in a world awash in dollars? So with a couple of minutes left, could you just sort of summarize our topic today by talking about that?
Yes, sure. Various analysts, like the World Gold Council, for example, look at supply and demand in terms of physical gold. And mine supplies around about 3,000 tons a year. You've got a further 750 tons of scrap, which is regarded as supply in the market. But this is nothing, absolutely nothing, compared with what goes on in the paper markets. I mean, if you look at the LBMA, the tonnage delivered, and this is delivered at end of day annually on the LBMA for this last year, was over 150,000 tons. It has been, I mean, go back to 1999, when the gold price was very low, it was up close to 250,000 tons. These are huge figures. So 3,000 tons. What's that? It's absolutely nothing. You've got exactly. You've got the forward market, which as far as the Bank of International Settlements is concerned, is called an over-the-counter derivative. You have got markets like COMEX. You have got the physical stuff. You've got all the turnover which isn't recorded of people buying and selling physical gold between themselves. I mean, the supply and demand situation is just absolutely crazy, and the advent of derivatives basically suppresses the price because anyone can with enough clout, for example, the Fed or a major bank can go in and sell, say, 5,000 contracts on COMEX, something like that, bang the price, and basically they're dealing in more than the annual physical supply. So you can see which, what's being wagged. The dog is being wagged by the tail, if you like.
Right.
Big time. And that's always been the situation and will continue until such time as we do get a big credit crisis.
A big credit crisis in which people no longer want dollars or other fiat currency, but demand physical gold. I guess that's what you're talking about, right?
Yeah, I think that's the consequence of the next crisis because of the amount of dollars that are awash in the system. And there is just another little thing which I'll drop in at this last moment, and that is the next credit crisis will occur for the first time when there are cryptocurrencies around. The amount of speculative move into cryptocurrencies could be, I say could be, because obviously nothing is certain, absolutely enormous, and could be another destabilizing factor.
All right, I hope we can talk to you about that sometime in the future. We are out of time. Thank you so much, Alasdair, for being with us once again.